What if I told you some of the smartest investors out there don't mind if the market goes up or down? They still find a way to profit. These investors aren't guessing. They're not buying stocks based on hype or hot tips. They're called quants, short for quantitative analysts, and they're changing how money is managed across the world. Instead of relying on instinct, quants use math, data, and computing power to find patterns in the chaos of the market. They turn those patterns into trading strategies, then automate the entire process, often with the help of AI. It sounds complicated, but let's break it down step by step. Step 1. Focus on returns, not prices. Stock prices jump up and down all the time. Take Apple in 2024. It dipped early, surged mid-year, paused, then climbed again. Trying to model this with a straight line? Doesn't work. That's why quants don't model stock prices directly. Instead, they look at returns, the percentage change in price from one day to the next. If Apple rises 1% today, that's a 1% return. If it drops 2% tomorrow, that's minus 2%. Why do this? Because returns level the playing field. They let you compare a $10 stock with a $1,000 stock fairly. They also help reveal patterns, hiding in all that noise. Step 2. Spot the bell curve. If you plot hundreds of daily returns for a stock and drop them into a histogram, a familiar shape starts to form. The bell curve, also called a normal distribution. It's not perfect. Real financial data often has fat tails, but it's close enough to be incredibly useful. And it shows up again and again in finance. Whether you're looking at Apple, Meta, Amazon, or Nvidia, their returns often follow this pattern. That bell curve has just two key parts: the mean, the average return, the standard deviation, how wildly the returns swing, aka the risk. Get these two numbers, and you can already say a lot about how a stock behaves. Step 3. Understand relationships, not just risks. Each stock has its own risk and return, but quants go deeper. They look at correlation, how assets move together. Two tech stocks that rise and fall in sync. High positive correlation. One goes up, the other goes down. That's negative correlation. Understanding these relationships is the key to managing risk. Instead of betting on one stock, quants build portfolios, smart combinations of stocks that balance each other out. Imagine you have two stocks and want to plot their returns. Instead of just two bell curves, you get a 3D shape, a hill-like surface. Viewed from above, it looks like an oval. The more stretched the oval, the stronger the correlation between the two. Step 4. Big portfolios, big problems. Now imagine building a portfolio with 500 stocks like the S&P 500. You'd need 500 return estimates, 500 risk estimates, and 125,000 correlation values. That's a lot of math. But here's the kicker: you don't have enough data. Even with a decade of daily returns, you're still short. To solve this, quants use clever tricks. They simplify the problem with factor models, they use Bayesian stats, and they tap into alternative data like credit card transactions or satellite images to get more insight. Step 5. Make money both ways. Most people make money when stocks go up. Quants can make money even when stocks fall. How? Through short selling. Short selling means borrowing a stock, selling it high, then buying it back lower. It's risky but powerful. And then there's pair trading. Imagine two companies, Alpha and Omega. Based on the data, you think Alpha will do better. Doesn't matter if they both go up or down, just that Alpha does better. So you short Omega and go long on Alpha. If Alpha drops 10%, but Omega drops 12.5%, you win. It's not about guessing the market, it's about understanding relative performance. Step 6. Build portfolios with math. Now let's put it all together. Quants use three key ingredients: a return vector, estimates of expected returns for each stock; a covariance matrix, a grid showing how all the stocks move together; a weight vector, how much money to put into each stock. The goal? Build a portfolio that gets the most return for the least risk. That's called mean variance optimization. They write an objective function, a formula that says maximize return, minimize risk, then add rules like don't short anything, long only; keep exposure balanced, market neutral. Software then runs the numbers and spits out the best combo of investments. Step 7. Automate everything. Once the portfolio is built, quants don't log into a trading app and start clicking. They run a Python script. This script connects to broker APIs and places trades in seconds. It can execute orders, monitor risk levels, Rebalance the portfolio regularly. It's like having a robot money manager that follows your rules perfectly, 24/7. Step 8. Go deeper with machine learning and AMP. Alt data. Modern quants are expanding their toolkits. Machine learning helps them predict price movements and spot patterns no human could catch. And then there's high-frequency trading, or HFT, where firms install their servers right next to stock exchanges, just to shave off milliseconds. Every microsecond counts, as they execute thousands of tiny trades per second using. Being a quant isn't just about crunching numbers, it's about turning uncertainty into opportunity. It's part math, part code, part market intuition, and it's one of the most powerful forces shaping modern finance. At Everstead, we believe you don't need a PhD to understand this. If you found this helpful, give us a like, hit subscribe, and check out the next video. Investing wisely isn't about guessing, it's about building systems. Quants do that with data, and now, so can you. Investing wisely isn't about guessing, it's about building systems. Quants do that with data, and now so can you.